Hello everyone. So, in today's video, I want to talk about why I love revenue growth. I think there's been a paradigm shift over the past 15 years in investing, and that the evidence is overwhelming in favor of looking at revenue growth, mostly, if not only revenue growth. Revenue growth is so important. So, why do I love revenue growth? Because you can't falsify revenue growth. Companies can tell you they have the best products, but it's cheap. Talk is cheap. What is a costly signal? What is a costly sign that customers love the product? Well, there is no better signal than customers actually buying their products with dollars, actually giving up their hard-earned dollars for your product. So I believe the top line, the revenue line, is the best way to assess product success. It's really the best way um, because it can't be falsified. Point number two, I love revenue growth because CEOs typically try to embellish numbers. Like whenever CEOs try to sell you on their company, they will pick their preferred number and they'll pick the number that makes them look good. And whatever number they pick, whether it's GAAP or non-GAAP metrics, these metrics don't necessarily represent the truth. For example, EBITDA can be very problematic because it can hide, maybe you have a legacy and old investment that is worthless today, but you're still depreciating. EBITDA is a problematic metric. Tons of metrics are problematic metrics because they may hide bigger issues with the business. Revenue growth doesn't hide anything. Revenue growth is the top line. You can't lie revenue growth. But I really think that earnings may be a problem because if you try to optimize your business for earnings and for high earnings, you may not be investing into the future. You may not be investing into your future growth, or you may have run out of investment opportunities within the business. And so you're not a growth investment anymore. You're becoming a value investment. So I prefer a business that has low earnings because they invest heavily in R&D, they invest heavily in wise marketing, and additionally, as taxes on companies are growing across the world, having earnings means you're having a lot of high taxes. So I really, really prefer low earnings as long as revenue growth is good and as long as the business is actually growing and reinvesting in itself. I want firms to reinvest in themselves wisely, of course. So what does that mean? Investment in R&D. R&D is so important, especially at the pace of technological innovation today. So I want to see wise investments in R&D at high return on investment, high ROIs. Investment in marketing is also something that I like, and that is okay if there is a clear return on marketing, i.e., your customer acquisition cost is superior to the lifetime value of your customers. And so a lot of companies in the SaaS world, for example, software as a service, it makes sense for them to spend quite a bit of money from their costs, spend all of that money to acquire customers because customers will stick around for a very long time. If you have a very sticky product, it makes a lot of sense. But if you're spending a lot of money on marketing just for a one-time sell, or for say brand awareness, I think it's a much more tenuous link that you can make between marketing spend and actually revenue growth and return. So be careful with marketing, but if there is a clear link between marketing spend and growth, long term valuable growth, then I'm okay with it. And then lastly, only small acquisitions. What you find is that oftentimes CEO will make too big of an acquisition, and there's just too high risks whenever acquisitions are high for CEO. So I do love a small acquisition. These are okay ways to spend your money to actually maximize your revenue growth and not focus on your earnings. And if firms can't reinvest at high ROIs, then it obviously makes no sense for a firm to reinvest in lower return businesses. So there's firms that are in this situation where they just run out of things to invest in that are actually going to be accretive. And if that is the case, what I like to see is a firm that does either buybacks or dividends. But I do not like firms that hold too much cash, because this channel is called Beat the Denominator. I believe the dollar is being diluted at 15% a year. So having enough cash to be anti-fragile and to withstand a storm in the market is important. But many tech companies have just too much cash. And if you have too much cash, especially right now, I would really enjoy to see you do stock buybacks or pay me a dividend so I can reallocate that value to things that are not going to lose like the US dollar, that are not going to be deflated like the US dollar. So these are the main reasons and things that I look for in favor of revenue growth. And there's just two quick warning signs that I want to point out. One of them is you need to watch bankruptcy risk, because obviously, if a firm is maximizing growth and doing everything towards growth, they may be at a greater risk of bankruptcy. That's why so many firms have been punished. So you want, at least when you go to the cash flow statement, you want at least to see positive free cash flows, and then the firm is safe, or negative free cash flow, but the firm has lots of cash, and it's not gonna run out of cash, the cash burn for like the next, I don't know, 5 or 7 years. So if a firm has negative cash flow but lots of cash, or positive cash flow, these are good signs. And the way firms do that oftentimes is they'll use stock-based compensation as a way to manage their cash flows and make sure they don't run out of cash. And that is okay with me. I think that is okay. The dilution of the number of shares outstanding in a company is generally not going to be as high as the dilution of the number of dollars out there and the dollars in the money stock. So I find that stock-based compensation is typically high when a company just does its IPO, but over time this abates. And so if it means avoiding bankruptcy, then stock-based compensation, in my opinion, is okay. The other warning sign is decelerating growth. So if a business's normalized annual revenue growth is, say, 40%, it's going to have an earnings multiple, or a price to gross margin multiple, or price to sell multiple. Its multiple is going to be dependent on its revenue growth. And if there is a sharp drop in revenue growth, then you may have an even sharper drop in the multiple of the stock. That's why I think the most important is to monitor the business's growth to make sure that they have a very large total addressable market and a very, very long runway, right? The best example of that, I would argue, is Tesla. Tesla is just at the beginning of the electric car transition. They have at least a 10-year runway before they run out of people wanting to buy electric cars. That's a good proposal. A lot of these SaaS companies have very, very long growth runway and very high total addressable markets, which means that they'll keep growing. But as soon as the growth decelerates because of the law of large numbers, it's a good idea to think about exiting the stock, because if growth slows, then the stock price of the business may slow even faster and even get into, say, a value territory type of valuation. So you really, really don't want that. So these were very quick slides, 3 quick slides about why I love revenue growth. I will make more videos about this and about my investment process. I hope you enjoyed the video. Thank you so much for watching.